These are all of the strategies, and I mean, there's a ton of them, but it's almost like a compass. Like, where is the direction my family is going to go when I'm gone? And that is the thing that I think most people overlook when it comes to generational wealth. You think if you just leave the money that's going to work out, but there's so much that goes into that. Hi, it's Dre Griggs with Obsidian Wisdom. Today we'll be discussing how to unlock generational wealth through strategic retirement planning. First and foremost, this video I'm going to go over everything, all the information that I have, my entire process that I give to each of my clients to help them unlock generational wealth through strategic retirement planning. I'm then going to invite you to go check out my free Wealth of Retirement Challenge at obsidianwisdom.com/retirement challenge. In it, I'm going to go in great detail because you're going to get the information today, but if you want to take action, that's what the challenge is designed for. You will finish that challenge with a retirement plan that you can then implement with your family to ensure that you unlock generational wealth. So if you don't know, there are 5 aspects of generational wealth that we discuss here at Obsidian Wisdom. Do you know which is the most important aspect of generational wealth? Let's talk about people who have the money and the money was gone. I don't know if you know, but 70 to 90%, depending on the study that you use, of generational wealth is lost by the 3rd generation. So that means having a bag of money is not the end-all be-all when it comes to generational wealth. You probably also know the majority of people who win the lottery file for bankruptcy within 3 years. All the money is gone. You may know that there are professional athletes who have a lot of money over their career, and the majority of them end up losing it all shortly after they retire. So the idea that all generational wealth requires is us to find a lot of money and then our kids will be able to live off of it is simply not true. So when people tell you to create generational wealth, all you have to do is get a life insurance policy, and then once you have that, you're going to be A-OK, and then your kids is going to get the money when you pass, and then they're going to be A-OK, and then your kids' kids is going to be okay. That's simply not true. And the numbers bear that out. If you are interested in creating unlimited wealth, then the most important thing that you can do is to build your wisdom. And now you may ask, well, Dre, exactly what is wisdom? And I can give you a couple of examples, but on the simple aspect of it, wisdom is experience. When those that have the experience know a little bit something different. So for example, if I was going to cut a tree down, you may say, look, all you need is an axe. And I would say, yeah, you're probably right. And that would be knowledge. Right? Knowledge is simply knowing to cut a tree, you need something sharp. So I have an axe. Wisdom would be understanding, what are we going to do with the tree when it falls down? What direction is the tree going to fall down? Is my axe sharp enough? Is there something more efficient than using an axe? Could I have a chainsaw? Do I need a team of people? All of these questions are going to be things that someone with wisdom has. You may say, I want to dig a pool. And you're like, okay, all I need is to shovel to dig a hole, which is true, a hole and then water. But you may say, well, where's the pipes laid? You may say, where's the wiring? Do I need a permit for this? That's the difference between knowledge and wisdom. And that's why people will often say, if you took all the money in the world and you gathered it together, and then you gave it out to each individual person in equal amounts, that the money will ultimately end up exactly back in the hands of the people who it started with. Because it's not enough to be given the money. You have to have the wisdom about how to make that money. And if you don't have the wisdom about how to make the money, what is ultimately going to happen? Then you end up back exactly with the life that you have now. The reality is we all know how to make the life that we have now. If we knew how to make something different, then we would have a different life. So the wisdom that someone has only allows them to live a lifestyle of $100,000 a year. Then no matter how much money you give them, they're going to revert back to that amount. That is the norm. There's going to be some days, so for example, if you and I were working out and whatever our weight is, we're going to have, sometimes we're like, man, this weight, I can't deal with this. I'm going to work out to lower the weight. And you'll be like, okay, so you'll work out for like a week or two. And then eventually what will happen? Eventually your weight will get back to something that you find manageable, something that's kind of decent, something that mentally is acceptable for you. And then what ends up happening? Well, then you start slowly creeping back up until you hit that number that is no longer acceptable for you. Money works the same way. There's a certain amount of money that we are able to say, this is an acceptable lifestyle for me. And then when you creep too low, you'll do something to bring the money back up. If you creep too high, the same thing is going to happen. You'll do something that brings the money back down. We don't inherently do it consciously, but it's based on the wisdom and the experiences that we have. So if you want to unlock unlimited wealth for your generational wealth to occur, you have to find people that have the experience and the wisdom that you need, and then they will give that wisdom to you, and then you have to teach that to your kids each generation. If you don't, then it's going to be lost at some point, and that's why it's lost by the third generation. The first generation, your kids saw you create the wealth. They have a good understanding of what it took, and as a result, they can repeat it on some level. But what they didn't understand and what wasn't made clear to them is that they would have to teach that to the third generation because they didn't see the growth. They have no idea what it took to make that happen. And so the third generation just squanders the money. They don't appreciate it. They don't have an understanding of the kind of person that's needed. They grew in wealth, they were born in wealth, and they lost the wealth. But someone that's a second generation, they grew in a regular life or poverty, and then they saw the wealth get created. You look at the likes of LeBron James, and you look at his son Bronny. His son Bronny is being fast-tracked to the NBA. Why is that? Because he already has the wisdom to give it to his son so that he can achieve the exact results that he wants. Denzel Washington's son, I just watched him in the movie Tenet, and he was great. But he was fast-tracked to that lifestyle because his dad already paved the path. Because he had the wisdom of how to accomplish it, he could show his son exactly what to do. If you look at Archie Manning, the quarterback in the NFL, his son Peyton and Eli Manning, both of them were NFL quarterbacks. Well, why is that? Because they had the wisdom, they fast-tracked the process to get them there. We can keep going of exactly what it would take, and I can even give you an example of someone that you probably don't know as well, but I read his article on CNBC and I thought it was interesting. And his name was Timothy Kim. Tim was on CNBC because he was famous for spending $70,000 over a 6-month span, and how he was able to become a millionaire because of his investing in the wisdom of others and how he was able to use that to create his own wealth. He talks about investing over a 10-year span and how he was able to turn a few extra $100 into $1 million of investments. And he said the first person that gave him the wisdom was a college professor who said, I just lost $60,000 in the stock market, but it's a great time to invest. You all have to go all in. And so he said he was putting money in here and there, investing in the stock market. It went up and went down sometimes, but then the money turned into $1,000. And he said, I think something's happening here. And he said it turned into $2,000 and $5,000. And then it turned into $10,000. And by the time he got to the $10,000, he said he was hooked. He said, this is amazing. And so we started investing a lot more of his money in the stock market. Now, it didn't hurt that he went through one of the great bull markets, so the money just kept going up for him, and that's just how it works out sometimes for some of us. But then he said he took that money and he wanted to go into real estate. So he invested learning the wisdom from a real estate developer. He said he wanted to learn about business, and he invested in some masterminds to sit with billionaires so they could teach him their business strategies. He invested in fireside chats. He invested in conferences. He wanted to learn the wisdom of those that have already accomplished the goals that he wanted. And by implementing it exactly as they told him, he was able to create even more wealth. Whether that was on social media, the marketing, buying real estate, investing in the stock market, he always knew that investing in the people who had the wisdom was the key to creating unlimited wealth. Now for you, you may say, well, Dre, I don't really know exactly where to start, but I will tell you it's a principle taught in The Richest Man of Babylon, and that is you invest with the people who already have the expertise in the area that you are looking to invest your money. And the way I would describe it with my kids is we don't go to Subway to order the pizza, right? You can't order the pizza from there. We want to go to an Italian restaurant and order fried chicken. Like there's just certain things that they have an expertise in, and if I go to that place, I'm going to order something that they have an expertise in. I'm not going to go to someone just because they have a wide array of things and they're going to offer me something within that. I want to go to someone who specializes in exactly what I'm trying to accomplish. Then so you want to put a team together, and you want to make sure that you talk to your children about the importance of investing with people who have the wisdom in that particular aspect. Otherwise, they're going to lose and squander their money. You also want to talk to your kids about exactly the mindset of someone who becomes a millionaire. Because being a millionaire is like, all right, well, that's fine. You got the money, but then what do you do after that? And it's less about the money. It's about who you have to become to get the money. And that's why I encourage everybody to become a millionaire, not because I think you need the money, but the money doesn't hurt, but because of who you have to become to get the money. at the end of the day, the money that you have is a sign of how much value you provide in other people's life. That's all wealth has been and ever will be. If you look on the list of the most wealthiest people in the world, you're going to find that the one thing they have in common is they're providing immense value in the most number of people's lives. Your third generation doesn't understand that part of wealth. So they think that the wealth is for them, but that's not true. The wealth is a sign of how much they help others. So your third generation, maybe they're spoiled, maybe they didn't understand that principle, so they provided no value, and then the money goes away. Because you're either giving value or getting value. And if all you're doing is getting value, i.e. a spoiled rich kid, then you're going to run out of money because they're just giving it to someone else who's creating the value. The second part of unlocking generational wealth through strategic retirement planning is your retirement readiness. And the reason retirement is so important to creating generational wealth is because if you haven't figured out how to free yourself from having to trade your time for money, then how could you expect your children and your future generations to figure that out too? Right. There are studies that show, I think I had seen one where it said the majority of people in the military have someone in their family that's been in the military. If you look up stats on poverty, poverty is cyclical, where there are people who are born in poverty and then they teach the exact process of being poor to their future generations, and then they are born in poverty, and it keeps going. That poverty is generational. When you find wealth, wealth is generational, where if you grew up in a house with lawyers, that your kids are more likely to be a lawyer. If you grew up in a house with athletes, they're more likely to be athletes. So if you grew up in a house where the only way you made money was by actively working, then it's more likely that your children are going to make money only by actively working. And as a result, and there are jobs that work out just fine for that, but if the goal is to free yourself, because what does retirement mean? The word retire is French and it means to withdraw. So we're not withdrawing from the world. We're not withdrawing from our friends and family. We're withdrawing from the trading our time for money. So if you haven't been able to teach your children how to free themselves because you haven't freed yourself, then they're going to live the exact same life in the same cycle that you taught them. So you must figure out exactly how to retire. And the best way to do that is to have a retirement plan, which is why if you're interested in a free retirement plan, you can go to the Wealthy Retirement Challenge. And over the 5 days, I will give you the exact process. And again, that's at obsidianwisdom.com/retirement challenge. And you will at least leave at the end of the 5 days with a retirement plan, where I know you go to these challenges and people don't actually give you value, and that irks me too. But this, you will literally leave with a retirement plan. You will have whatever the probability of success is, you will know exactly what that is. And if you follow that plan, you will get the results that you want. And you may say, well, Dre, why on earth would you do that? Don't you want to sell that? Because as much as we all hear people talk about, oh, I could just invest in an index fund and set it and forget it. Do you think any of the Fortune 100 people are investing their own money? Right, but do we think they're dumb, right? Are they being bamboozled? Are they being tricked by us crafty financial planners? Of course not. There is value in having a financial planner who reads the books on a regular basis and having a team of experts who are looking out for you, where they're lowering your tax bill, where they're helping you transfer the wealth, where they're making sure that you don't lose your assets if you were to be sued, and they're also making sure that you don't run out of money from poor investments. It just makes sense to have a team. Now, the cool thing about retirement planning is most people think if I have the money, then I'm going to be happy. But I've been around long enough to tell you that that's not true. If you want to be happy, then you need to spend your time doing things that bring you pleasure and bring you purpose. And I took those from the Happiness by Design book, and it's a great book, and I love it. And so there are 8 aspects that I will talk about when it calls the beginning of happiness. And the idea is if I do one thing in each of these categories every day, then I'm going to feel great about my life. Whether I have the money or I don't have the money, I'm going to feel great about my life. The mistake that most people make is they're saying, okay, I will take the trips with my family. I will visit my parents. I will do all these amazing things. I'll volunteer. I'll do all this stuff when my money's right. Well, sure, you could do it more when the money's right, but you can do something now that will bring you fulfillment and joy, where people tell you, act as if this is what we're talking about. Don't say, I will do it one day. Say, I'm going to find a way to do it today. And a retirement plan is the first step of that. So we'll talk about all of your dreams and your goals. I would have that in my retirement plan. What do I want to do with my time? Where do I want to travel? How much will that cost? Who will I travel with? I would have in my retirement plan all of my expenses and my budget and how much money I need to allocate, what percentage of my income goes towards my retirement, and then it will tell you how long that money should last. What type of return do I need for that money to last? All of this is part of a retirement plan. And I do think that once you have that information, that most of us feel really good. We just don't know how much money we have and we feel overwhelmed by it. But once you have the exact numbers and the process in place, then you're like, okay, I know exactly what I'm doing. I know where my money is going. This makes sense for me. And our third of the 5 steps is long-term investing. Short-term investing is whatever the neatest fad is, but you're not going to build generational wealth investing in whatever the cool thing of today is. You'll find the most common mindset among the most wealthy is about capital preservation. They're not interested in investing in something that has a 50% chance of working and a 50% chance of them going broke. They don't play the lottery. They don't go to Vegas unless, of course, it's just their play money, right? And we all can have that. Whether you want to go golfing or surfing or you want to go to a casino in Vegas, I believe whatever you want to do with your gambling money, you can do that. And so if you said, you know what, Dre, in my gambling fund, I'm not interested in going to Vegas, but I do want to invest in crypto or Bitcoin, I'd say, cool, that's your gambling fund. You should do that. But if you're saying, Dre, I'm going to invest in Bitcoin and crypto and I'm going to build generational wealth, I would say pump the brakes. How long do we think these things are going to last? I'm big on understanding the economics and then making investment decisions off of that. So that's called the top-down approach, where we go through these economic cycles. If you're not aware, I have a bachelor's and master's in economics. So this is just what works for me. And long-term investing, it may not work for you because you're not as interested in that. But what we can say is what makes money in the stock market, what makes money in the real estate, what makes money in business, it changes over time. It's no different than if you were to get, I don't know, any sort of a flu shot or really any of those shots. They make updates to those shots every single year. Well, why do they do that? They do that because the virus adapts. And the same is true in economics. So if everyone goes in the stock market, the thing that was making money will not make money anymore because the market adapts. The inefficiencies in the market are gone as we continue investing in those things. Or we drive the price up so much. As you look at like NVIDIA right now, I believe it's up like $400 year to date, which is crazy. I mean, that's several hundred%, all because people believe AI is going to be the new, biggest, bestest, amazing money-making thing. Well, at some point, there isn't any growth potential for you. You may believe in the AI revolution and that artificial intelligence is going to change the world. But if you invest in a company that is already trading several $100s over its earnings, so that's your price to earnings ratio, and the number very much just means like how many dollars am I willing to spend on this to get $1 of earnings in a return. So if I walked up to you and I told you, for every $30 that you give me, I will give you $1 of earnings. You may say that's a good deal. Generally, we would say someone that has a company that trades under a price to earnings ratio under 30 is probably a good deal because there is going to be some growth unless the company just disappears. Then because we don't think the company is going to disappear, then if I'm able to get $1 of earnings for every $30 that I give you, I know that as the company appreciates, I'm going to make more than that. But if you look at NVIDIA that's trading several $100 price to earnings, well, that means that the company would have to make like $200, $300, $400 in the price just for you to get $1 of return back. And now we're starting to look at some of the bubbles when you get to those kind of numbers. And we go through those cycles. And so it happens, and I'll give you a very short history. So when it comes to long-term investing, once you understand the cycles, then you won't get caught in them. So what ends up happening is we have a great economy, which is what we just came out of. And as the economy is great, what usually happened? We came out of a recession. So we go to the trough is what it's called. So that's the bottom in a recession. And then you start expanding. And we call that growth. Well, as we're expanding and growing, what ends up happening? The economy gets really hot, where there's 500,000 jobs every month. Everybody's getting raises. Money is flowing all over the place. The shelves are going empty. Well, then what ends up happening? Everybody says, well, dang, my shelves keep getting empty. I need to raise my price. What's the other reason I need to raise my price? Because I have to pay my employees more because the market is so great. The unemployment rate is so low that everybody has to be paid more to stay or else they're going to leave because they're going to get a 20% raise if they get the next job. And so now we have all this extra money. Well, what would you do with extra money? Most people are going to go buy something. And so whereas we're buying something and the shelf is emptying and the demand is up, well, now I got to raise my price to meet demand, and I got to raise my price to meet the cost of my staff. And then we start having inflation because there's a whole bunch of money in the economy. Normally, the Fed lowers the interest rates to help us get out of the recession, which is what we just did. And then what happens? Now you reach what we call the peak, so the very top of the economic cycle. So as a result, the prices are so high, the jobs now are full, and everybody is kind of just sitting there, and then the Fed is like, inflation's so high, I'm going to start raising the rates back up so that we can lower the prices. Well, what does that mean in plain English? In plain English, to lower the prices requires people to not have as much money anymore. So as the Fed increases the interest rates, now your house costs a little bit more, where if your interest rate is like 7%, well, that's a lot less house than you can get at a 1% interest rate. And where you're looking at your car loans, that's a lot less car you can get with a 7% interest rate, where things are going up. And now you have this debt. Well, how does that impact you? Well, now you're not buying as many houses, so the housing market slows down. You're not buying as many new cars, so the automobile industry slows down. What about the businesses that borrow money to expand and grow? Well, the money is more expensive for them too. So now growth usually slows down. So these businesses, they're being hit by these high rates just the same as the rest of us. And then ultimately what ends up happening? Well, now the shelves are full, and so the company has to lower its price. And once the company lowers its price, there's a high chance that they have their demand issues still. And so now they start getting rid of some of the people that were working for them. The Fed knows that for me to decrease the inflation, I have to increase the unemployment. That's their relationship. If I increase unemployment, then people will have less money, and then the companies are going to be able to hire you for less money. And if they hire you for less money, then you can spend less. And as you spend less, inflation is going to decrease. And so that will throw us into recession. So the Fed is going to say, we just want to tiptoe into the recession. We don't want to drop us into a depression. But you and I both know that as the rates are increased, that it's kind of a difficult dance. And that we end up, because of market sentiment, that we end up firing everybody. We end up laying off everybody. And everybody doesn't have a job. And then everybody's looking for a job. And now instead of us demanding $300,000 a year, now we're okay accepting a job for $60,000 a year. Because we increase the interest rates, all the money now is drying up out of the market. And then that cycle is what we go through. Well, people's spending habits work in a very similar way. And I know it's kind of a long way, but the reason I told you all that is if you're investing in things like Bitcoin and crypto, these are going to be things that are going to be hit with certain economic cycles. And you being overinvested in any one sector is going to open you up to the bubble, because the bubble always is going to pop. So in the 90s, when everybody was investing in tech companies, it was because tech companies were growing and they're getting like 90% returns. So what do you do as a business owner or a person with reasonableness? You would build a tech company because everybody wants to put money in a tech company. So that's what happened. Everybody made tech companies, and then in the end, it was these companies selling for crazy amounts of money where there was no ability to make your returns back. Poof, money's gone. Same thing happened in 08. The rates were great on houses, so everybody's investing in houses. And then what ends up happening, everybody's saying, well, dang, if you're just giving mortgages to everybody, then we're just giving mortgages to everybody. And then what happens? Poof, pop, bubble pops. Now all the houses, they're devalued, a bunch of foreclosures, yada, yada. Same with the metaverse. Everybody's like, meta's going to be the new biggest thing. So we all invested in the metaverse stocks. Poof, it was gone. Everybody's investing in cannabis. Cannabis, oh, it's amazing. It's going to be legal in the whole country. Everybody's going to be able to have it. There's going to be cannabis candles and clothes and everything. And then everybody invested in the next cannabis stocks, and then poof, it was gone. And so now we're in the artificial intelligence, where everybody's like, I got to find an artificial intelligence company. They're all going up. Well, this is amazing. But the cycle is the cycle. So for you to long-term invest, I will generally tell people it's important to diversify your investments. And I will give you a couple of examples. So there's a couple portfolios that you can use, and I will link them for you in the video. But one of the examples of a portfolio is called the permanent portfolio. And so these are ones that are focused on long-term investing. And so when it comes to the permanent portfolio, that is 25% in the stock market, and then you can kind of work that any way you want. 25% in long-term bonds, 25% in cash, 25% in gold. The idea is there's generally 4 types of events that happen. We either have inflation or deflation, and we either have economic growth or economic decline. So if you have something that performs well in each of those markets, then you should be in a pretty good spot. for long-term growth. You won't like one part of your portfolio at any given time because they don't all perform well, right? Gold doesn't perform well during economic growth as much as it does during a recession, and everybody's leaving these failing businesses and going to where gold is, and gold is safe. And you can explain that, and hopefully not as long as it took me to explain it to you guys, but I did want you to have a little bit of background information of why long-term investing is different than short-term investing. Short-term investing, I invest in whatever gives me the highest growth, but statistically speaking, if you chase the return, then that is going to always be a losing proposition, because as the price increases, it then becomes almost impossible for you to make a profit off of it. Imagine if I was going to sell you my house. You may say it's a great deal if I sell you my house for $100,000. You may say it's a fair deal if I sell you my house for $400,000. And you may say it is outrageous if I sold you my house for $40 million. Where some of you are investing $40 million in something that's not even worth $1 million. Another long-term asset allocation would be 20% in the stock market, 20% in the small caps. It's usually like $1.5 billion or less. And I wouldn't go into the penny stocks because that's ridiculous, but I would say maybe $100 million. So if the company has revenue and capitalization of $100 million to $1.5 billion, I would say that that's probably enough information that you can look at the fundamentals, you can look at how the company's performing and decide if it makes sense for you. And then you'd invest 20% in long-term bonds, 20% in short-term bonds, and 20% in gold. So this will outperform, generally speaking, the permanent portfolio because you have more money in equities and you're focusing on growth as well, but you're still hedging some of the risk of a recession and inflation and different things like that. So you still have the ability to have a long-term outlook. Now you may say, Dre, well, what are some things I should look for in a long-term company? And I would say it's no different than, really any situation. So one of them we talked about was the price of the earnings. So I always care about the earnings. I care about the projected growth. I care about the leadership team, how qualified and expertise they are. I usually care how much money they have invested in the company. It's very difficult for me to believe the company is going to work if the leadership team is not equally invested in the company. And for some of you, that may just mean, does the leadership's payment structure align with me? So do they get paid by making decisions that interest the stockholders, or do they get paid by making other types of decisions? Then I would say you just want to make sure that you're aligned. And the one good way is if they're invested in the company equally with you, or not equally, but they're also invested in the company in a pretty good percentage with you. For most of these, I look at most companies from a 5-year perspective. I will give you grace for 2020 because that was COVID. I probably won't hold that against you. But outside of that, I do expect to see consistent, continuous growth. I do look at cash flows. I do look at your price to book ratio. I do look at how much debt you're carrying as a company, just regular stuff. When I'm investing in a company, when I'm buying stocks, I look at stocks the same way if you walked up to me and said, hey, I want to sell you my business. And I would say, okay, how much is the business earning? How much revenue does it bring in? How long have you been in business? How consistent are the revenues that you're generating? These are just normal questions that I believe most people overlook because they don't look at stock market investing as buying into a business, which you should. When it comes to long-term investing, it's important to keep in mind the 7 revenue streams that the IRS says that they recognize. And if you have 3 of these streams, the IRS says 65% of their self-made millionaires have at least 3 revenue streams. And the streams fall within 3 categories. It's a business, it's real estate, and it's the stock market. Now, the 7th one is actively working, where you have a job and you get paid, which I do believe counts as a stream. But as far as the diversification, there's 3 main streams: stock market, real estate, business. If you have a business, that opens you up to have revenue streams through profits, and you can have revenue streams through royalties, where you make something once and then you sell it. That could be a book, you get royalties from a book. It could be music, it could be a patent or an invention. All of these could be that. When it comes to real estate, you normally get the rental income, and sometimes you can get capital gains because it does appreciate. But in real estate, you normally, if you keep your real estate and you grow it, capital gains, in case you're wondering, means that I've had it for a year and a day. And if you have it for a year and a day, it's just not considered regular income. It's considered capital gains. And so that's just something nice. So you have the rental income that comes from there. And then the stock market, which is where I have most people start out at, because the stock market has the lowest barrier of entry. The stock market also has the most opportunity to access each of these revenue streams. If you're buying a stock, you're already buying in a business. If you buy in a real estate investment trust, then you're already buying real estate and you're getting rental income. You also have the capital gains. You can invest in companies solely based on their patents and their trademarks, so you can invest in something that has royalty income that also is being generated. And then you also have investment income, which is like your dividends, and then you have your interest income, which is like payments for debt. So if you bought a U.S. bond, they would say, give me $1,000 and I'll give you $10 in 5 years, right? We'll, just throw numbers out there. Well, that's considered interest income. So you have the ability to access the most streams of revenue through your stock market investments. Now, some people, they're just not interested in stock markets, but that is, in my opinion, because you don't have an understanding of the stock market. And what I mean is 50% of the stock market is owned by the top 1% in the world. So the top 1%'s investments makes up half of the stock market. That's crazy. And 80% of the stock market is by the top 10%. The way I would describe it is, if you've ever seen movies like Rounders or Casino, where people can go to Las Vegas and there's a process, there's a mathematical equation to where they're able to create the results that they're looking for. And yes, you're right that the majority of people do lose money when they go to the casino, but it's not because the casino is rigged against them, which I guess it technically is, but it's because they don't have an understanding of how the game is played, where you're supposed to invest the money, which games that you should play, which one gives you the best odds of winning, and how to create the best results in your favor. Investing is just like that. You shouldn't invest in things where the people who have these institutions where they're investing billions of dollars and they spend millions of dollars on research, we shouldn't try to compete against them. We should invest in very risky assets that is going to cause us to lose our money in a short amount of time, because we're either going to make a lot or we're going to lose a lot. We should invest in plans that gives us the best chance of winning over the long period of time. And that's something that is of interest to you. Of course, I invite you to check out the Wealthy Retirement Challenge, where you get all your questions answered by me, and then you'll at least have a retirement plan, and you'll have the investment strategy that you need to achieve long-term generational wealth. The fourth aspect is estate planning. So we won't spend as much time here because I'm being mindful of the length of the video, but estate planning is, how do I transfer my wealth? Transferring your wealth is a huge thing. You want to make sure you limit your taxes. You want to make sure you limit the argument with your family, where everybody understands. Now, some of these things that we all know about is whether you want to have wills and the different kinds of trusts that you want to have. But there are so many trusts that are available. And I have a separate video where I talk about 5 reasons to have a trust, and I'll link that there for you. But a trust provides you immense value in ways that you can structure your family wealth so that you pay the least amount of taxes. Now, I have another video where I talk about 7 ways to be able to avoid the gift tax, where if you structure your family wealth in one of these ways, where it gives you the ability. One of them that I'll tell you is, if you pay the money directly to the hospital or the university for your kid to go to college, well, now you don't have to worry about the gift tax because you're paying it directly to the institution. You can do that. If you have a business with your kid and you end up giving them money through the business, that would be considered payment for services rendered. It would be no different than if a CEO was to step down from a company and that CEO was given what we call the golden parachute. The idea is they earned that money. They worked in the business and were simply payment for services rendered. So that would also avoid the estate and the gift tax as well. And then when it comes to the cap, and that amount changes each year, it's really right under $13 million right now, where is your estate, if you transfer more than $13 million, then you will have the gift tax on whatever amount is transferred over that. But in addition to the assets, you may want to have power of attorneys, that if someone has incapacity planning needs where there's mental drops in someone's awareness where you get disabled, you already have these plans in place. You may have wishes on your health and how you want to be taken care of. And you may have things that you religiously oppose. If you have these already set up, then the doctor and your family already knows what you will and won't do. If you're donating your organs, or if you don't want blood transplants, or if you don't want certain vaccines or shots, however you want to structure it, you can already have it written out. And you have this already sealed and taken care of. There's so much that goes into estate planning. Even if your children aren't completely grown, have you talked to the person that's going to take care of them? Do they know? Do they know what your kids like? Are your kids aware of what they're going to do? Do you have these emergency plans in place? Do you have family meetings and family governance? And all family governance is what are the core values of our family? What are the things that we're okay investing in? Or do we want to invest in businesses? If we do they have to talk to 2 or 3 senior family members to get the approval, or can they just get the money if they want to? If they have health issues and they need to have a surgery, is that carte blanche where no matter what the amount is, they can get the surgery? Or do we have to have some sort of an approval process? What about their spouses when they marry? You guys know that divorce is high. And with the divorce rate so high, does that spouse automatically get access to the generational wealth, or is there certain rules that they have to be in a certain amount of time? These are all of the strategies, and I mean, there's a ton of them, but it's almost like a compass. Like, where is the direction my family is going to go when I'm gone? And that is the thing that I think most people overlook when it comes to generational wealth. You think if you just leave the money that's going to work out, but there's so much that goes into that. Not only does it transferring the wealth and making sure you pay the least amount of taxes, but the fifth and final one is building that family dynasty. Do you have those core values? Do you have those rules in place? Do your family know what they can invest in, what they can't invest in? What passion projects and philanthropy, where are you donating your money? Where do they donate their time? How do they access the money? All of these are things that you really want to think hard about when it comes to creating and unlocking generational wealth.